Oh,
Like,
BlackRock's terrible. You know, they're
right.
one of the worst players on Wall Street. They're completely without morals whatsoever. Their business model is just repackaging stocks and selling them as ETFs.
We have been part of the huge revolution in investing through ETFs.
You know, they own more, their ETFs own more stocks than there are stocks. And they charge a fee for that. And they have incredible political influence that they use to make it easier for them to game the system. They are really a plague on capitalism.
It just identifies how much money laundering there is being done in the world.
Crypto enthusiasts think the launch of the first U.S. exchange-traded funds that hold Bitcoin is a done deal, but it's not. The U.S. Securities and Exchange Commission approved 11 spot Bitcoin ETFs on January 10, 2024. Until then, the regulators have been reluctant to approve any spot Bitcoin ETF applications, citing concerns over market manipulation, fraud, custody, and investor protection. The SEC had previously rejected several applications for a spot Bitcoin ETF by Grayscale Investments, a leading digital asset manager. In August 2023, a federal appeals court ruled that the SEC was wrong to reject Grayscale's application and had not sufficiently explained its reasoning. However, the SEC decided not to appeal the ruling. In January 2024, the regulator announced approval for Grayscale's application, as well as other applications by major industry players such as Bitwise, BlackRock iShares, WisdomTree, ARK21 Shares, and Invesco Galaxy, among others. All 11 ETFs began trading on January 11, 2024, including Grayscale's. SEC Chair Gary Gensler released a warning along with the approval. He said, "While we approved the listing and trading of certain spot Bitcoin ETP shares today, we did not approve or endorse Bitcoin. Investors should remain cautious about the myriad risks associated with Bitcoin and products whose value is tied to crypto." But why have the regulators been so reluctant to approve any spot Bitcoin ETF applications? Let's start from the beginning. The SEC has denied 16 Bitcoin ETF applications from 16 different companies. In 2017, the SEC issued its first Bitcoin ETF to none other than Tyler Winklevoss and his brother Cameron. The Winklevoss Bitcoin Trust had sought to list and trade shares of an ETF that offered exposure to Bitcoin. However, the SEC determined that their application failed to demonstrate how it was consistent with the Securities Exchange Act of 1934, which requires exchanges to be designed to prevent fraudulent and manipulative practices. Applicants that followed the Winklevoss one were met with the same response and failed to prove that Bitcoin markets were uniquely resistant to fraud and manipulation. The SEC ruled that such exchanges could satisfy the 1934 Act through comprehensive surveillance sharing agreements that help to ensure the availability of information necessary to detect and deter potential manipulations and other trading abuses, thereby making the ETF less readily susceptible to manipulation. A comprehensive surveillance sharing agreement is defined as the sharing of information about market trading activity, clearing activity, and customer identity, that the parties to the agreement have reasonable ability to obtain access to and produce requested information. The SEC further pushed for the importance and definition of a surveilled, regulated market of significant size. It argued that for approved commodity trust exchange products, there was at least one regulated market for trading the underlying commodities such as gold and silver. Funnily enough, the requirements of a regulated market of significant size and a significant market came to be known as the Winklevoss standard. However, what is the SEC concern for not approving the Bitcoin ETFs in the past? The SEC's grave concern surrounding Bitcoin spot ETFs is market manipulation. In its Winklevoss standard, the regulator defined a market as one in which there is a reasonable likelihood that a person attempting to manipulate the ETP would also have to trade on that market to successfully manipulate the ETP, so that a surveillance sharing agreement would assist the ETP listing market in detecting and deterring misconduct. Another requirement is that it would be unlikely that trading in the ETP would be the predominant influence on prices in that market. To the SEC's credit, it made suggestions about how applicants could satisfy their requirements. When it came to Bitcoin futures, the SEC said there is a lead-lag relationship between the Bitcoin futures market and the spot market. The SEC said a would-be manipulator of the ETP would need to trade on the Bitcoin futures market to successfully manipulate prices on those spot platforms that feed into the proposed ETP's pricing mechanism. If the spot market leads the futures market, this would indicate that it would not be necessary to trade on the futures market to manipulate the proposed ETP, even if arbitrage worked efficiently, because the futures price would move to meet the spot price. Transparent price discovery is thus imperative for the SEC, and whether Bitcoin's price is determined by the Bitcoin futures and spot Bitcoin markets. Please subscribe if you find this video informative, and please hit that notification bell so you will be notified when we drop another video. Here's what they're not telling you about the Bitcoin ETF approval. Just because the SEC has approved these investment products, that doesn't mean they're safe for ordinary investors. The prospectus for the Fidelity Wise Origin Bitcoin Fund is 112 pages, but you need to read only 6 paragraphs before you're hit over the head with the following in all caps. The shares are speculative securities. Their purchase involves a high degree of risk, and you could lose your entire investment, and disclosures from other providers use the same language. The new Bitcoin products are not your standard issue exchange-traded funds, which, like mutual funds, are typically registered under the Investment Company Act of 1940 and come with more regulatory protections than these investments. Instead, these exchange-traded products are subject to looser controls around their fees and conflicts of interest. In addition, the Securities and Exchange Commission doesn't have the same authority to conduct examinations of these products as with typical ETFs. Another thing to take in consideration is that this new Bitcoin products will be held by a third party. Most of the new ETFs have hired Coinbase to be their custodian, which means it will be responsible for the security of all the private keys to Bitcoin held by these ETFs. It is also likely to be the exchange where much of the trading occurs when the shares of these products are created and cashed out. Another thing they are not telling you when it comes to this new Bitcoin products is tax implications, is that the Internal Revenue Service views Bitcoin and other digital currencies as property, not currency, which means it is treated similarly to an investment in stocks. The tax treatment of Bitcoin ETF will be similar to holding Bitcoin directly. If you've held the shares for more than a year in a taxable account, any gains would be taxed at the less onerous capital gains rates, generally 0.15 or 20%, depending on your taxable income and tax bracket that year. Short-term gains, which apply to investments held for a year or less, are taxed as ordinary income.
Let me say, investors should be aware, I'm saying this in my own voice, that the underlying Bitcoin cash markets, there's not the robust oversight that you have in the stock markets or in the derivatives markets. Our sister agency oversees Bitcoin futures, but those underlying cash markets do not have those investor protections.
Investing in a crypto ETF is likely to be more expensive than buying cryptocurrency directly. When buying crypto, you only need to make a one-time payment to the exchange, which can be as low as a few hundredths of the value traded. When investing in an ETF, you pay your brokerage's trade fees, if any, and the fund's expense ratio. Crypto ETFs have expense ratios ranging from 0.39% to 0.95%, much higher than the transaction fees charged by crypto exchanges. And another thing is that investing in a crypto ETF means not owning the crypto directly. Even the fund won't hold the currency directly if it's a crypto futures ETF. And a drawback shared by all ETFs is that you give up some control. You rely on the fund manager's strategies, so more complex or precise strategies are unavailable. Finally, you are more limited when you can trade crypto ETFs. Typically, you can only buy and sell ETFs during normal market hours. Crypto exchanges often run 24 hours a day, 7 days a week, and 365 days a year. Crypto ETFs enable institutional and everyday investors to speculate on the price of these currencies. Nevertheless, it's important to understand the differences between crypto ETFs and direct investment in crypto, such as higher fees and the lower amount of control you'll have over the digital assets. Before investing in crypto ETFs, it's important to note that crypto is a relatively new and significantly volatile asset class. Before plunging into these investment waters, it's always prudent to get professional advice first.